In our prior session, we learned how to construct a bank reconciliation. You should see it on your screen right now. So now what we're going to do is we're going to talk about how do we get the information from our reconciliation into our accounting records. After all, in our accounting records, we have a balance of $10,450, but the balance is supposed to be $14,290. The only way to get information from a worksheet into our accounting records is through our book of original entry, known as our general journal. So what we need to do is we need to create our general journal now. So if we go to the general journal, we are not going to be concerned about any of the things that happened up here. The bank error was for the bank to fix. The deposit in transit, it's already in our books. The night we made the deposit, we debited cash and credited sales. And the outstanding checks, those are also in our books. The day we wrote the checks, we debited utilities expense and credited cash. So those are already in our books. But the things that aren't in our books are the things down here, the adjustments to our cash ledger. We need to get from $10,450 down to, or up to, $14,290 so that our books properly reflect the accurate balance of our cash so it can show up on our balance sheet under assets. So I like to do it in combined entries. I like to take these items right here, the ones that are added, and make one entry, and then take the items that are subtracted and make a second entry. So let's go ahead and look at the journal. So the date was June 30th of 2021. So first thing we want to do is we want to look at cash. So going back to our bank reconciliation, how much was cash debited for? Okay. So if we're looking at it, our cash was actually debited for $4,065. All right, so we're going to debit cash $4,065. Now, what were the things that we listed under the addition to our cash that included was included in the $4,065? Well, the first thing we had was we had a note collected by the bank. All right. So what we're going to do here is we're going to go ahead and we're going to debit notes or credit notes receivable for the amount of the amount collected minus the interest earned. So the total amount collected was $4,040, which included $160 of interest. So the amount of the note then was going to be $3,880. The interest needs to be listed differently because the note receivable or the principal of the note was debited to notes receivable. And now that they're paying us off, we need to credit it to make sure that that asset no longer is there. It's now been converted into cash. Then we have interest income or interest revenue, whatever you want to call it. It's going to include the $160 from the note plus the $25 from the bank. So that's going to give us a total amount of $160. Oops, so sorry, $185. So we have $185 of interest added to $3,880, and that gives us a total of $4,065. Now, could we have done it separately? Sure. We could have debited cash for the $40.40 and credited notes receivable for the $3,880 and then interest income for the $160 and then done a separate entry. But I think it's easier utilizing the bank reconciliation for us to go ahead and do these combined entries. All right. So let's go back and let's look at our bank reconciliation again. Okay, so now we've taken care of the additions. Let's go to the subtractions. We need to reduce our cash by $225. Now, how do you reduce cash? With a debit or credit? Right, credit. So we know that that's going to be our credit for $225. Our debit is going to be a combination of the bank charges, the NSF check, and the correction of the sales. All right, so let's go back to our journal. We're going to skip a line, enter our date again, and we're going to put in our bank charge expense. Now, you can use miscellaneous expense, but like I told you before, I'm not a big fan of miscellaneous expense. I think that if the bank starts charging us too much money and we put it into an account called miscellaneous expense, we could have a problem with this not being noticed, and all our money could be going to the bank. But if we have an account called bank charge expense and we start noticing it getting higher and higher and higher, it might be time to get a new bank. All right, now what about the NSF check? Well, when we find out that this customer's check bounced, we're going to pick up the phone, we're going to call the customer, we're going to say, hey, you so-and-so, your check bounced and you owe me money now. When a customer owes us money now, it's an accounts receivable. But it's not just for the $70 check. We're going to bill them for the $15 fees, because after all, we wouldn't have incurred those fees had they not bounced the check. Okay, then the other thing was we had made an error. We had debited cash and credited sales revenue for $500 when it actually should have only been for $400. So we're going to have to debit the sales revenue for $100 to reduce it to correct the error. So it was only supposed to be $400. We had it at $500. So by debiting it, we're going to reduce the sales revenue and bring it back down to the proper amount of $400. And then we're going to credit our cash for $225. So if we add these three numbers together, we do end up with our $225. Once these entries are made and posted to the general ledger, our cash account will properly reflect the balance of $14,290, which will then be used on our balance sheet. All right, next session, we'll be covering